how the ultra-rich prepare, while everyone else panics. Every time a market crashes, the news anchors say the same thing: diversify your portfolio, stay calm, wait it out. And millions of people follow that advice. They hold their mutual funds. They watch their retirement accounts fall 40%. They tell themselves it will come back. Sometimes it does. Sometimes it takes a decade. But while ordinary investors were waiting it out in 2008, Warren Buffett was deploying $15 billion in 6 weeks. While ordinary investors were waiting it out in 2020, the world's billionaires collectively added $1.3 trillion to their net worth in the same 12 months that 22 million Americans lost their jobs. This is not luck. This is not genius. This is preparation. The ultra-rich don't react to crashes. They prepare for them. 18 to 24 months in advance, they have a playbook, and nobody teaches it in school. Today, we open it. Asset 1, the ammunition. In the months before a major crash, the financial media always runs the same story. Billionaires sitting on mountains of cash. Warren Buffett hoarding $150 billion in treasury bills. Experts say he is missing the rally. Experts say he's being foolish. The experts are wrong. Cash in the hands of the ultra-rich is not laziness. It is not fear. It is not a failure of imagination. It is ammunition. When markets are rising, every asset is expensive. A great company trading at full valuation costs full price. There is no structural advantage for the buyer. You are paying what the asset is worth, which means your upside is limited to whatever growth occurs from that point forward. But when markets collapse, that same great company trades at 40, 50, sometimes 60% below its actual value. Not because the company became worthless, because panic doesn't discriminate. Panic sells everything. The bad alongside the good, the weak alongside the strong. In September 2008, Goldman Sachs was in crisis. Its stock was collapsing. Confidence in the entire financial system was evaporating. Warren Buffett called. He offered $5 billion, but not on normal terms, on his terms, a 10% guaranteed annual return. Warrants to buy additional Goldman stock at a fixed price. A deal structure so favorable, it was only available because Goldman was desperate and Buffett had cash. By 2013, that single investment had generated over $3 billion in profit. Cash doesn't earn much in normal times. In a crash, cash is the only asset that gets stronger as every other asset gets weaker. This is why the ultra-rich hold it, not because they fear missing the rally, because they are waiting for the moment when the entire market goes on sale, and they know that moment always comes. Asset 2, distressed debt. Most people have never heard of distressed debt investing. That is not an accident. When a major company files for bankruptcy, ordinary shareholders panic. They sell their stock for whatever they can get. Sometimes pennies, sometimes nothing. They assume the story is over. The ultra-rich assume the story is just beginning. Here is how the structure works. When a company goes bankrupt, it doesn't simply disappear. Its assets, its real estate, its equipment, its contracts, its brand value still exist. They still have worth. But its debts need to be restructured. Distressed debt investors, hedge funds, private equity firms buy that debt at enormous discounts. A bond worth $1 face value might trade for 20 cents when the company is in crisis. If the company successfully restructures, that 20-cent bond recovers toward full value. The return is 400%. If the company's assets are sold in liquidation, the debt holders get paid before the shareholders. The shareholders receive nothing. The debt holders receive everything. In 2020, dozens of major American retailers collapsed. Shopping malls that had been built over decades, valuable real estate in prime locations, suddenly had no tenants and desperate owners. Distressed debt investors moved in quietly. They purchased the debt of these dying retail chains at deep discounts. When the restructuring was complete, they owned the real estate, not the failing retail business, the land underneath it, land in locations that had taken decades to develop and could not be replicated. The ordinary investor saw a bankrupt retailer. The distressed debt investor saw an underpriced real estate portfolio temporarily obscured by a failing business on top of it. The crash didn't destroy the value. It just changed who owned it. Asset 3, agricultural land. In 2023, Bill Gates was the largest private owner of farmland in the United States, 270,000 acres across 18 states. When this was first reported, the reaction was confusion. Why would the world's most prominent technology investor be buying dirt? The answer is a concept called caloric necessity. People can stop buying cars during a recession. They can stop buying houses. They can stop buying stocks, bonds, luxury goods, and technology. They can delay, postpone, and eliminate almost every category of discretionary spending. They cannot stop eating. Agricultural land produces the one commodity that has never in the entire recorded history of human civilization experienced zero demand: food. And unlike financial assets, farmland cannot be printed. It cannot be created by a central bank decision. Its supply is fixed permanently by geography. When currency loses value through inflation, farmland priced in that currency rises. When financial systems destabilize, assets that produce physical necessities hold their value in ways that paper assets cannot. During the 2008 financial crisis, U.S. farmland values declined less than 5%. The S&P 500 declined 57%. During the inflationary period of 2021 to 2023, farmland values in the American Midwest rose over 25%. The ultra-rich don't buy farmland because they want to grow wheat. They buy it because in any economic scenario, currency collapse, financial crisis, hyperinflation, deflation, land that feeds people retains its fundamental value. It is the asset that cannot go to zero, because the day it goes to zero, nothing else matters either. Asset 4. Blue chip fine art. In 2008, the worst financial crisis since the Great Depression, the S&P 500 fell 57%. Blue chip fine art, the top tier of the market, works by artists like Picasso, Basquiat, and Warhol, fell approximately 4%. 4% versus 57%. This is not coincidence, it is structure. The fine art market at its highest levels operates almost entirely outside the public financial system. Major works are sold through what are called private treaty sales, direct transactions between seller and buyer, negotiated privately, recorded minimally, no stock exchange, no public filing, no transparent pricing mechanism. When financial markets collapse and regulators scramble to understand where wealth has moved, a portion of it is hanging quietly on the walls of private residences and inside temperature-controlled storage facilities that most people don't know exist. The Geneva Freeport, a warehouse facility in Switzerland, is estimated to contain over $100 billion worth of art, wine, and valuables. Assets stored there exist largely outside the normal systems of taxation and transparency. This is not illegal, it is architecture. Financial architecture designed over decades to allow certain assets to exist at a distance from conventional financial systems. Fine art at the highest level also has a supply problem, in the best possible way for owners. There will never be another Picasso. The number of museum-quality works is permanently fixed. Central banks can print currency. Governments can issue bonds. But no institution on earth can manufacture another authenticated masterwork by a dead artist. Fixed supply. Persistent demand from the wealthiest buyers on earth. A transaction system that operates largely outside public view. This is why the ultra-rich treat fine art not as decoration, but as a store of value that financial crises consistently fail to reach. Asset 5. The boring monopolies. During the 2008 financial crisis, luxury goods companies lost billions. Real estate developers went bankrupt. Banks required government rescue packages funded by taxpayers. Waste Management Incorporated, the largest garbage collection company in North America, maintained its revenue within 3% of pre-crisis levels throughout the entire collapse. People never stopped producing garbage. Not during recessions, not during depressions, not during pandemics, not ever. This is the concept of inelastic demand. Certain goods and services are consumed regardless of economic conditions, not because people choose to prioritize them, because the alternative to consuming them is unacceptable. Garbage collection, pest control, funeral services, water utilities, basic healthcare, essential food distribution. During every major recession in the last 50 years, private equity firms and ultra-high net worth investors have systematically acquired companies in exactly these sectors. Not because they are exciting, because they are certain. A pest control company in a mid-sized American city does not experience a recession in any meaningful sense. It experiences consistent, predictable, essential demand, regardless of what the Federal Reserve does with interest rates or what the stock market does with valuations. Between 2008 and 2012, the funeral services industry in the United States underwent significant consolidation. Regional chains were acquired by larger operators. Pricing power increased. Margins expanded. The families using these services had no alternatives. The investors who owned them had no competition. Boring, in the language of sophisticated investors, is not an insult. Boring means predictable. Predictable means reliable. Reliable means you maintain your position while everyone else watches their portfolio collapse. The ultra-rich don't buy boring monopolies despite the crash. They buy them because of the crash, when prices are depressed and competition has been eliminated by fear. The pattern. Wealth is not destroyed in a financial crash. It is transferred from those without a playbook to those with one. From those who were told to diversify and wait to those who spent 18 months accumulating ammunition. From those who held assets in a panic to those who had the cash to buy those assets at the bottom. This pattern has repeated in every major financial crisis in modern economic history. 1929, 1987, 2000, 2020. Each time the mainstream narrative is identical. Nobody saw it coming. Everyone is equally affected. We will recover together. The data tells a different story. After every major crash in the last century, the concentration of wealth at the top increased, not because the ultra-rich got lucky, because they were prepared for an event that the system, by its nature, produces periodically. The system is not broken. A broken system produces random outcomes. This system produces consistent ones. The same assets outperform in every crash. The same strategies generate returns when markets collapse. The same structural advantages compound across generations. This is not conspiracy. It is architecture. Financial architecture built over centuries that rewards preparation and punishes panic. The distance between the two groups, those who transfer wealth during a crash and those who have wealth transferred away from them, is not intelligence. It is not connections. It is not luck. It is knowledge. And the decision to act on it before the crash arrives. 5 assets. Cash, the ammunition that buys everything at the bottom. Distressed debt, the restructuring play that converts crisis into ownership. Agricultural land, the indestructible necessity that feeds people regardless of what currencies do. Fine art, the store of value that financial crises consistently fail to reach. Boring monopolies, the inelastic demand machines that produce revenue regardless of economic conditions. This is the playbook. It has been followed quietly, consistently across generations, by the people who emerge from every financial crisis wealthier than they entered it. History doesn't hide this information. It simply assumes you won't look for it. We looked. If this gave you a new perspective, subscribe to Economic Chronicles, the hidden history of money and power. We'll show you where to look.